If you leave a pound coin sitting in a drawer for a decade, the metal stays intact, but its ability to buy things slowly dissolves. In 2026, holding cash is an active asset allocation. Every day your money sits in a zero-interest account, you are making a deliberate choice to forfeit purchasing power. This line chart maps the 2026 UK inflation rate directly beneath the Bank of England base rate. That gap between the two lines is your baseline hurdle. To actually grow your wealth, your cash needs to earn a yield that clears the inflation line. Let's compare a £10,000 balance over 12 months. On the left, a lazy allocation earning 0%. On the right, an optimized allocation capturing top yields. In the final row, the lazy allocation forfeits hundreds of pounds, a voluntary penalty for not moving your money. Failing to actively optimize where your cash lives guarantees a measurable mathematical loss of your purchasing power to inflation. When people realize they need to move their cash, they usually search for the best savings rates. Immediately, they are hit with hundreds of conflicting leaderboards, and decision paralysis sets in. The core flaw of these leaderboards is that they rank different financial vehicles against each other. They stack individual savings accounts next to fixed bonds and regular savers, despite their different rules and structures. Optimizing your cash depends on your liquidity needs, your total deposit volume, and your current tax bracket. Securing a 6% rate provides no value if the account's strict rules lock your money away when you need it to pay a sudden boiler repair bill. To cut through the noise, we use the cash allocation matrix. This framework forces you to evaluate exactly what trade-offs you have to make to access 2026's premium yields. True optimization requires matching the strict rules of an account to your specific life circumstances. Chasing a headline percentage blind will only trap your cash. This flowchart starts mapping our matrix at the most critical node. Do you require immediate 24/7 access to your funds? If yes, you follow the branch to easy access accounts. Easy access accounts are your Tier 1 vehicle. You can deposit or withdraw cash instantly, penalty-free. Because emergencies don't give you notice, this account type is mandatory for your baseline emergency fund. The trade-off for total liquidity is twofold. Interest rates are generally lower, and they are variable. The bank can cut your rate at any time. If you have excess cash beyond your emergency fund, the flowchart expands down the No branch. It asks, can you lock this money away for a year or more? This leads to fixed bonds. Fixed-rate bonds are your Tier 2 vehicle, designed specifically for lump sum optimization. You deposit a set amount, and the bank locks in a guaranteed interest rate for the term's duration, usually 1 to 5 years. The major catch here is absolute illiquidity. Once your money is in a fixed bond, you cannot access it for emergencies or move it if inflation spikes and better rates appear elsewhere. You're locking your capital inside a vault. You get a guaranteed higher yield because the bank knows you cannot ask for the money back early. To secure the absolute highest guaranteed yields in the UK market, you have to completely surrender access to your capital. Our third evaluation node asks, are you actually paying tax on your savings? If yes, the matrix branches off into cash ISAs. An individual savings account, or ISA, acts as your Tier 3 vehicle. Every UK adult gets a £20,000 annual allowance to place inside an ISA, permanently shielding any interest generated from UK income tax. But there is a hidden penalty. Because they offer tax-free status, banks know they don't have to compete as hard on the raw numbers. Headline rates on cash ISAs are typically 0.2 to 0.5% lower than their standard non-ISA counterparts on the open market. This brings us to the Personal Savings Allowance, or PSA. The PSA allows basic rate taxpayers to earn up to £1,000 in interest every year completely tax-free, outside of any ISA. This split comparison shows the math. A basic rate taxpayer earning £500 in interest is well under the £1,000 PSA limit. By putting your money in a lower rate cash ISA on the right, rather than the higher rate standard account on the left, you generate less absolute cash. A tax shield only provides value if you carry an actual tax liability. Without one, an ISA is an unnecessary drag on your absolute returns. Tier 4 of the matrix belongs to regular savers. These accounts are aggressively marketed toward people trying to build a monthly savings habit. They come with incredibly rigid input requirements. You are forced to make strict monthly deposits, often capped at low amounts like £150 or £200 over a 12-month period. You cannot drop a lump sum in on day one. The hook is the massive percentage rate. Banks use highly inflated headline figures, sometimes 7% or higher, as loss leaders to acquire your data and cross-sell you other products. The illusion breaks down when you apply a high percentage to a drip feed structure. Your final month's deposit only sits in the account earning that 7% for a few weeks before the year ends. Look at this side-by-side matrix comparing the headline rate to the actual pounds earned. On the left, a 7% regular saver capped at £150 a month yields roughly £68 in interest after a year. On the right, a 5% easy access account holding a £5,000 lump sum yields £250. Managing regular savers requires calendar reminders, high administrative friction, moving small amounts every 30 days, all for a very low absolute monetary reward. Chasing the highest percentage rate printed on a billboard is a mathematical trap if the account rules severely restrict your deposit volume. We must step back and evaluate the entire 2026 savings landscape holistically, looking past individual account features. This quadrant chart maps all 4 account types based on their core trade-offs. The vertical y-axis measures your yield, and the horizontal x-axis measures your liquidity. Easy access sits in the bottom right, high liquidity but lower yield. Fixed bonds sit at the exact opposite extreme, zero liquidity but high yield. Regular savers sit on the lower end of liquidity due to their strict drip feed rules, and cash ISAs float across the matrix, shifting entirely based on your individual tax status. Finding the right account is a delicate balancing act. You are constantly weighing access against reward. The overarching rule of the matrix is simple. Yield is strictly a payment from the bank. They are paying you to either surrender your liquidity or navigate their administrative friction. To allocate your cash effectively, you need a strategy tailored to your exact profile. Let's examine this structured scorecard detailing 3 distinct approaches for 2026. If you fall into the beginner or time-poor profile, trade optimal yield for total simplicity terms. If you are a higher rate taxpayer, prioritize cash ISAs above all else. Your goal is to avoid losing 40% of your earned interest to His Majesty's Revenue and Customs, or HMRC. And if you are an optimizer with time and capital, you utilize a hub and spoke model to seamlessly blend liquidity with high yields. This diagram illustrates the mechanics. You keep 3 to 6 months of expenses in a central easy access hub, ensuring immediate liquidity. Then you funnel any excess cash outward, locking it into 1-year fixed bond spokes to capture guaranteed returns. Different components snap into place to form a functioning, optimized system that protects your baseline while maximizing your upside. Stop chasing generic leaderboard percentages. The only way to truly protect your purchasing power is to optimize your cash allocation to match the exact reality of your life.